Singapore Exchange is now trading at a price-to-earnings ratio of 34.8 times its trailing 12-month earnings. That is an 18.8% premium to its fair value. For a retiree, the result is a dividend yield compressed to just 2.06%. I have been watching this one for a while, and the number that finally made me sit up was that yield figure. This is one of those pieces where I had to run the data twice because I simply could not believe the valuation gap the first time around. My job is simple, even if the balance sheet is not. I read the numbers that the headline skips, the interest coverage, the gearing, the free cash flow sustainability, so that the Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. The current price sits at 21.67 Singapore dollars. The core issue is that this price is 18.8% above the investing pro fair value of 17.52 Singapore dollars. When you buy in at 34.8 times trailing 12-month earnings, you are paying a massive premium. And this premium forces your dividend yield down to just 2.06%, which is exactly where the forensic problem begins for anyone needing income. RHB research has given the exchange a neutral rating and raised its target price slightly from 20.30 to 20.90 Singapore dollars. Their argument is built on the April 2026 daily average turnover of 2.1 billion Singapore dollars, up 6% year-on-year, down from a record 2.4 billion in March. The market is broadening, with the Straits Times Index share of value traded falling from 85% to 74% as small and mid-caps gain ground. Here is what that activity looks like in numbers. Retail trading of small and mid-cap stocks surged 20% month-on-month. 700 million Singapore dollars of institutional flow moved into this segment over the last 12 months. Derivative contracts hit 30.2 million, only 1% above last year. The real velocity came from secondary placements, bringing in 3.13 billion Singapore dollars year-to-date, with April alone doubling that pace. Because of these higher volumes, RHB revised its profit estimates upward. They are projecting a 1.4% bump for fiscal year 2026, a 3.2% increase for fiscal year 2027, and a 3.1% rise for fiscal year 2028. Their new daily average turnover assumption for fiscal year 2027 is now 2.022 billion Singapore dollars, up from 1.889 billion previously. But forecasting only 5 new initial public offerings in the second half remains a real constraint on long-term growth. And here is the load-bearing assumption the entire institutional thesis rests on. The stock is undeniably expensive relative to its own history. The analyst values it at 26 times fiscal year 2027 earnings, 2 standard deviations above the 12-year average, plus a 4% environmental, social, and governance premium. To justify a positive rating from here, there must be either stronger earnings growth or a meaningful pullback in the share price. Our first metric is the trailing dividend yield. The raw fact is 2.06% based on an annualized payout of 0.435 Singapore dollars per share at today's price. The payout grew from 0.32 to 0.435, 36% over 5 years. But the yield stayed between 2 and 3% because the share price rose in parallel. For your wallet, this fails the 3.2% forensic floor. It does not beat the CPF ordinary account at 2.5%, and it sits 194 basis points below the CPF special account's 4.0% with zero risk. Metrics 2 and 3 cover corporate gearing and interest coverage. Total debt of 683 million against assets of over 4 billion yields a gearing ratio of 16.4%, well below the 35% ceiling, and improving from a 20.5% peak in fiscal year 2022. The interest coverage ratio is exceptional at 43 times, against a 3-year average of 62.6 times. Even under stress, income down 10%, interest costs doubled. The coverage stays above 20 times. No solvency risk, no dilution threat, capital fully protected from borrowing cost pressures. Metric 4 confirms the fortress balance sheet. Cash of 2 billion and 46 million against debt of 683 million gives a net cash surplus of 1.363 billion Singapore dollars. But metric 5 exposes the valuation disconnect. The stock is trading at an 18.8% premium to fair value. A 10% market correction would take the price to approximately 19.50 Singapore dollars, and late buyers would absorb that capital loss while still earning below floor income. The compliance gate summary is clear. Trailing dividend yield at 2.06%, fails the 4.7% minimum. Corporate gearing at 16.4%, passes the 35% ceiling. Interest coverage at 43 times, passes the 4 times floor. Net debt to EBITDAIQ, net cash position, passes comfortably. Valuation alignment, trading at a premium to fair value, fails. One soft flag, trading above investing pro fair value. The yield hard gate failure is the determinative issue. This asset is assigned zone 5, the red zone. The yield hard gate failure is the single trigger. At 2.06%, the dividend yield falls 114 basis points below the 3.2% forensic floor. A fortress corporate balance sheet and an unusable income yield can coexist. They do here. The dividend trajectory tells an interesting story. Revenue moved from $1,232,000,000 to $1,371,000,000 to a trailing 12-month figure of $1,425,000,000. Net profit rose from $598 million to $648 million to $650.7 million. Cash balances expanded from $1,135 million to $1,509 million to $2,046 million, while debt fell steadily. The business is entirely healthy and highly cash generative. And that brings us to the entry price problem. Operating cash flow of $826 million easily covers financing outflows of $479 million. Dividend cut risk is very low. But even if the exchange grows its payout 10% to 0.478 Singapore dollars annualized, your starting yield on today's purchase price stays firmly locked below what CPF delivers with absolute zero risk. Here is the gap between the analyst verdict and our forensic screen. The analyst rates it neutral based on broadening small and mid-cap velocity, targeting a 12-month institutional cycle. We place it in the red zone because of severe yield compression versus household inflation, looking at multi-decade retirement sustainability. They see an acceptable valuation against the 12-year average. We see capital starvation compared to risk-free baselines. The institutional manager is happy to capture capital appreciation from a net cash monopoly and focuses on the 2.1 billion daily volume mechanic. The retirement investor needs actual cash per dollar of risk capital deployed. With electricity tariffs rising and headline inflation running at 1.8%, a 2.06% yield cannot serve a drawdown portfolio. The institutional case rests entirely on a theory that retail and institutional flows into smaller stocks will support a higher price to earnings multiple. Secondary placement volume of 3.13 billion Singapore dollars is a real metric, but that operational velocity does not translate into actual cash flow for you. Buying momentum at a deep yield discount is an unnecessary compromise for an income investor. High exchange turnover means very little to your portfolio if transaction volume leaves your personal income account structurally starved. The red flags were always there. The difference between a sanctuary and a yield trap is decided before the opening bell, not after the damage is done. Gearing ratios, debt overhangs, yield compression against risk-free rates. The signs are visible. The forensic framework reads these warning signs before the price moves. Iggy's elite investors receive this full forensic breakdown, all the gearing ratios, the debt overhang, and the yield gaps before the market opened, for just 9 Singapore dollars a month, which is less than a kopi and kaya toast set at Raffles Place. You get 0-day reports, the complete red zone watch list, and institutional grade analysis that flags the landmines disguised as opportunities. Check the link in the description. 3 things to watch next. First, monitor the full-year dividend declaration. Watch whether the payout ratio accelerates significantly from its current 64.54%. Substantial acceleration is needed to close the yield gap at today's price. Second, watch the 2.022 billion daily average turnover target. We need sustained volume, not short-term spikes, to justify the institutional multiple. Third, look for a pullback toward the 17.52 Singapore dollars fair value that would restore the yield toward approximately 2.48%, still below the forensic floor, but closer to a re-entry conversation. The CPF reality check is unavoidable. The 2.06% yield from this asset sits below the 2.5% you get from the ordinary account with absolute zero risk, significantly lower than the 4.0% zero risk return of the special account. A fortress corporate balance sheet completely loses its utility if the entry valuation prevents you from drawing a defensive income. The business is an absolute market monopoly with 1.363 billion in net cash, an interest coverage ratio of 43 times, broadening liquidity, and near zero bankruptcy risk. But the entry price at 34.8 times trailing earnings creates a 2.06% yield that fails our forensic floor by 114 basis points. It underperforms risk-free instruments while absorbing equity pricing risk. The verdict shifts depending on your investor type. For the accumulator with a 10-year runway, this is a quality business at the wrong price. Worth watching, but not worth buying at an 18.8% premium with compressed income. For the drawdown investor living off distributions, the answer is clear. At a 2.06% yield, this stock cannot contribute meaningfully to a retirement income portfolio. Monitor list, not allocation list. The principle is simple. Separate the operational quality of a business from the investment utility of its equity at a specific price. Singapore Exchange stays on our radar. We monitor the valuation gap closely. Until the entry yield crosses back above the forensic floor, it stays outside our active income allocation boundaries. The key numbers tell the whole story. Current yield 2.06% fails the 4.7% forensic floor. Trailing price to earnings ratio 34.8 times, well above the 12-year average. Interest coverage exceptional at 43 times, not a risk. Stock trading at an 18.8% premium to fair value of 17.52 Singapore dollars. Great company, wrong price, wrong yield, wrong entry for retirement income. Watch the 17.52 Singapore dollars fair value alignment. Watch the payout ratio. Watch sustained daily average turnover above 2.022 billion Singapore dollars. Until then, monitor, don't allocate. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.